Lynas Rare Earths and Arafura are pricing a structural shift, not a trade cycle bounce. And the gap between those two readings is now the defining position question for ASX critical minerals investors. China controls 70% of mined rare earth supply and more than 90% of global refining capacity. When Beijing imposed export controls on 7 medium and heavy rare earths in April, the immediate read was a tactical tariff war retaliation against Washington. That surface reading is incomplete. In the US market, buyers are reporting rare earth prices running up to 5 times the Chinese reference price, a magnitude that signals physical shortage at the product level, not just a diplomatic signal at the policy level. The US response moved this from geopolitical posturing toward capital allocation. Washington directly invested $400 million in MP Materials, the country's only domestic producer, and established a floor price of $110 per kilogram for neodymium-praseodymium oxide, double the ruling price at the time. That floor price subsequently flowed through to Lynas's Japanese offtake terms, meaning a U.S. government price guarantee now sits under Lynas's revenue structure, not just under a domestic American producer. The Arafura Nolans project in the Northern Territory, receiving significant project status last week, represents a further step. It is the first declaration under the Territory Coordinator Act, a regulatory designation that compresses approval timelines and reduces sovereign risk for offshore capital. Arafura's share price had already surged 110% since early October, with foreign and institutional capital from the Europe, Canada, Korea, Australia Financing Coalition underwriting the project's final investment decision. The price surge preceded the significant project announcement. The regulatory confirmation is now absorbing what retail positioning had not yet caught. What the move cannot yet confirm is whether the U.S. floor price structure is permanent enough to sustain Lynas and Arafura's re-rated market caps if China eases export restrictions to rebalance the market on its own terms.
The same week that foreign capital was moving into ASX rare earth names, domestic capital was accelerating its exit from Sydney and Melbourne property, and the two moves are not coincidental. Sydney dwelling values fell 0.9% in May alone, down 2.1% over the prior 3 months, with the median house value retreating from $1.6 million in February to $1.58 million. Melbourne fell 0.8% in the month, down 2.3% for the quarter. Cotality's research director Tim Lawless noted that estimated sales volumes in Sydney and Melbourne dropped 17% and 14.2% respectively, against levels a year ago, a fall in transaction volume that precedes further price deterioration when advertised supply is simultaneously rising above historical averages. The triple pressure structure is the key. The RBA lifted the official cash rate to 4.35% during May. Treasurer Jim Chalmers' budget introduced changes to negative gearing and capital gains tax, and affordability had already been stretched beyond income growth in both cities. Each element alone would slow a market. The combination is producing a different dynamic. Potential buyers are not waiting for a better entry price. They are withdrawing from the market entirely, with listings accumulating on the supply side and transaction depth thinning. Cotality's estimate of a 10% national decline does not distribute evenly. Perth jumped 1.4% in May and is up 25.6% over the year, with a median house value still below Melbourne's at $1.039 million. Brisbane rose 0.8%. The divergence isolates Sydney and Melbourne as rate and tax-sensitive assets rather than a national story, and the property exit is coming precisely from the market segments with the most leverage, not from the regional markets where yields remain competitive. For investors holding leveraged Sydney and Melbourne property, the position pressure is whether the RBA's next move arrives before negative equity materializes across mortgages written at peak prices in 2023-24. That question connects back to the critical minerals trade. Capital that is not deploying into Sydney housing at current prices is either sitting in cash or rotating somewhere else.
Pro Medicus is the clearest observable answer to where domestically oriented capital has been landing as it exits rate-sensitive allocations. The company's shares had shed roughly 60% from their September 2025 peak on fears that AI would disrupt subscription-based software platforms, what the market was calling a SaaS apocalypse scenario. The mechanism by which AI was supposed to destroy Pro Medicus's value was never fully specified, but the fear was real enough to compress multiples across the entire ASX software sector. What today's session reversed was not the AI question, but the positioning that had been built on it. Pro Medicus announced 2 new U.S. hospital contracts, a $16 million 7-year deal with Tidal Health covering Delaware, Maryland, and Virginia, and a $28 million 5-year renewal with Allegheny Health across 14 Pittsburgh area hospitals.
The combined new contract value for FY26 reached $400 million, by management's account the largest sales year in the company's history, and double the level of 2 years ago. Neither Tidal Health nor Allegheny opted for short-term contracts that would have preserved flexibility to switch to AI-native alternatives. That duration signal is the positioning evidence. Institutional hospital buyers with multi-year capital planning horizons chose contract lock-in over optionality. Shares jumped up to 12% in the session. The capital flow is interpretable from price and volume action, institutional accumulation rather than retail chasing, given the discipline of the move. SiteMinder added 11% separately, suggesting the re-rating is spreading across the ASX technology sector rather than remaining specific to Pro Medicus. The verification point is whether the $400 million contract base holds through FY27 without renewal attrition. Pro Medicus' CEO explicitly left open the possibility of further M&A and investment activity after the company's Pro Medicus stake in 4D Medical returned strong gains. The residual question the rare earths repricing left open, whether structural scarcity trades can hold if China eases controls, now has a domestic counterpart. Whether the Pro Medicus re-rating survives if a genuine AI-native imaging alternative reaches clinical validation in the next 12 to 18 months. Both trades are long structural scarcity, one in minerals and one in certified medical software, and both are currently priced on the assumption that the scarcity condition is durable. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.